Welcome to another session of Folk Accountancy Tutorials. Today we are going to continue our lesson on the final accounts of company, and then we are going to take a practical question and we are going to solve it together. In our previous video on the final accounts of companies, we learned how to prepare the final accounts of company. We studied the format of the income statement for companies and then for the income surplus account, as well as the statement of changes in equity. And then we explained that you either be required to prepare the statement of changes in equity alone, or you'll be required to prepare the income surplus account. And also, we also recapped the format of the statement of financial position, paying particular attention to how the finance by portion of the statement of financial position will look like. And we are going to take a question to that effect and use this illustrative example to try and explain the concept that we have already studied in the part 1. And then afterwards, we'll go into final account for publication according to IFRS. Okay. So without wasting much time, let us look straight away at the question and then try and solve it together. Okay. Anokoko Company Limited has an authorized capital of 80,000 ordinary shares and 60,000 10% preference shares of no par value. The following trial balance appeared in the books of the company on 31st March 2019. So that is the trial balance. We have trade receivables and payables to be $16,000 and $14,000 respectively. We have stock or inventory at 1st April 2018 to be $9,250. We have purchases and sales. We have land and building, freehold property to be $12,500. We have furniture and fittings to be $5,000. We have goodwill to be $9,000. We have delivery van to be $12,000. And then we have wages and salaries to be $6,600. And then we have administrative and general expenses $5,600. Selling and distribution expenses $2,700. Then we have discounts to be $800, but it's on the credit side. So you should know that it's a discount received. That is why it's on the credit side. And then we have provision for depreciation for 2 different assets. For furniture and fittings, we have $2,000, and then for delivery van, we have $3,200. Then we have directors' remuneration. We have auditors' fees. We have the income surplus balance at the beginning to be $9,500. That's the opening balance for income surplus. We have a capital surplus of $6,000 also in the trial balance. And then we have stated capital made up of 60,000 ordinary shares fully paid at a value of $36,000. And then we have 40,000 10% preference shares, which is also fully paid at a value of $20,000. And then we have 50% debenture at a value of $8,000. And then we have preliminary expenses to be $10,000. We have the bank balance of $22,500 on the debit side and a cash balance of $6,600, giving us a total of $180,900 for both sides. So these are the additional information we have as follows. I/1. Closing stock was valued at a cost of $5,000. Then the second one says that the directors has recommended the following. So they have recommended the following. A, that $1,900 goodwill should be written off. So that is goodwill to be written off. B, 1,000 Ghana cedi preliminary expenses should be written off. I will explain that to you. And then C, a transfer of 2,500 is to be made to capital surplus. And then D, a dividend of 10 cents per share be paid on ordinary shares. And then the next one, I. Furniture and fittings and delivery van are to be depreciated 10% and 20% respectively on cost. And the final one is that the corporate tax for the year is estimated to be 3,000 Ghana cedis. You are required to prepare A, the income statement for the year ended 31st March 2019, and then B, income surplus account for the year ended 31st March 2019, and then finally the statement of financial position as at 31st March 2019. So this is your question. So this is quite different from the final account of a sole trader in a sense that now with this trial balance you can see that there are some new items that are popping up which we may not have seen from the case of the sole trader, like the director's remuneration. You see, this is a company, we are talking about a company, and a company is usually mandated to have board of directors, and you need to pay the directors an amount of money usually as remuneration or allowances, and these also come as expenses to the company, just like the normal wages and salaries will come as expenses for the employees. The directors are also remunerated. And then you can also see an expense like auditors' fees. Now most companies, depending on the laws of the country, but now it's almost everywhere, that companies are required, especially the limited liability companies, are required to have their accounts audited by external audit. Okay, and when these auditors come and audit your account before you publish it, the auditors will charge you a fee for the audit, and the audit fee comes in as an expense to the company. So that is what you can see in your trial balance as auditors' fees. There is also the opening balance of the income surplus, which I have explained to you in the previous video. We are going to use to prepare the income surplus account. But then I also see under the stated capital we have ordinary shares, and then we have the preference shares. Now let me explain something to you, that ordinary shares are actually the shares that belongs to the owners of the company. Preference shareholders are usually not the actual owners of a company, and so preference shares are treated as debt instruments rather than equity instruments. And so I'm going to explain that to you as we move on. And then let me also add something. You know, we know that preference shareholders receive their dividends first before the ordinary shareholders, as we have always been saying, because preference shares carry a fixed rate of interest or a fixed rate of dividend. And as you can see from the question, they didn't just say 40,000 from the trial balance, they didn't just say 40,000 preference shares. They mentioned the percentage, 10% preference shares. Now, 10% preference shares means that you have to calculate 10% on the value of the preference shares as dividend every year. And that is the meaning, it's a fixed rate of dividend. Just like debenture. After that, you're going to see debenture on the trial balance. And we see a percentage attached to the debenture, 15% debenture. Now let me explain this to you. Debenture is also a long-term liability, just like any long-term loan. So it's a loan, it's a liability to the company. Now, just like debentures, any other loan will come with a fixed rate of interest in a trial balance. What it means is that you calculate 15% on the value of the debenture, and that is going to go as your interest expense on the debenture. However, you should be careful to go through the trial balance to be sure that there are no debenture interest paid. If there is any debenture interest paid in the question, we expect that the amount of payment made for the interest should be equal to the 15% of the value of the debenture, which we know is supposed to be paid. So if the value that has been paid is different or lower or higher than the value of the interest that is actually supposed to be paid, the difference could be an accrual or a prepayment. Like for example, in this case, the debenture value is $8,000. And so if you calculate 15% of $8,000, it's going to give you $1,200 if I'm right. Now, this $1,200 is what should actually be paid in the year for debenture interest. So if you see anywhere in your trial balance that there was debenture interest, even if you didn't write paid, all expenses in the trial balance have been paid. That is the meaning. I have explained that in my video on adjustment for final accounts. So the debenture interest that has been paid, if the debenture interest paid on the trial balance is, let's say, $1,000, then what it means is that you always need to calculate your 15%. Then you know that you should have paid 1,000 to you have paid 1,000. So the difference of 200 will come as debenture interest owing in your statement of financial position as a current liability. So you should be careful. If this was, let's say, 1,005, meaning you are overpaid by 300, that 300 will go as a current asset in the statement of financial position as debenture interest prepayment. So these are some of the things you should know. And if there was nothing at all like debenture interest paid in a trial balance, then it means that the whole amount of 1,002 has not been paid. And so in as much as it will go as an expense, you remember to also take it as a current liability, or the 1,200 as debenture interest owed. So these are some of the things you should know. When there is any expense which has not been paid, and they will not tell you it has been paid or not, you should check from the trial balance. All expenses paid will be found in the trial balance. Once it is not in the trial balance, it means that that expense was not paid. So that is what about debenture. And then there is one other one that most of us may not have heard or seen before, and that is the preliminary expenses. Now in the question we have preliminary expense of $10,000. Now this preliminary expense, what is it about? Preliminary expenses are expenses that were incurred during the process of the formation of the company, and they were incurred before the company began its operations. And so most of the time they are so huge that we don't want to write them off in 1 year. So imagine that you have incurred, like in this case, it's about $10,000. You have incurred an expense of $10,000 during the process of forming the company before the company came into existence. So we call it preliminary expenses. Now, these expenses, even though it's an expense, we expect that it should be written off in the income statement before we arrive at the net profit. However, if you write all these 10,000 off in the first year, because usually in the product life cycle, the early stages are not so profitable, you may end up incurring a very huge loss, which may discourage you from even continuing the business. So prudently, what we usually do is that instead of writing this off as an expense, we capitalize this expense. So this preliminary expense is going to be capitalized as part of non-current assets in the statement of financial position, so that every year we write off a portion as an expense. So the number of years that we will be able to write it off. So if you are going to use 10 years, it means that just like we treat depreciation of non-current assets, we are going to divide these preliminary expenses into 10, and then it's going to be 1,000 each year. So every year we write off 1,000 as expense, and then we reduce the value of the preliminary expense that has been capitalized as part of the asset year after year, so that by the end of the 10th year, we would have written off the expenses that was made before the formation of the company. That is what we call the preliminary expense. You can see from the second additional information, the recommendations of the directors, the P, that $1,000 of preliminary expenses should be written off. So that is the meaning, that is what I was explaining. So we are going to capitalize this whole 10,000, and then we write off only 1,000. So the net value of this preliminary expense will now be 9,000 at the end of the year. So the following year we write off 1,000 year after year until this whole expense has been taken off from our books. But until then, we are going to capitalize it as part of our cost of the assets. I don't know if you understand what I'm trying to explain. Okay. Now, let us come on to the additional information. Now, in the additional information, there are no new things with the exception of the director's recommendation. Now, one thing that I have noticed with this question is that there are no accruals and prepayments mentioned in the additional information. It could have been, okay, we treat it the same way. But the focus of this question that I'm giving you now is just for you to understand how to treat things in the income surplus account, and then understand how different the company accounts is different from the sole trader. And then from there, the other questions that are ahead of us that we are going to look, especially in the case of a published account, we are going to look at a blend of all that and then see how best we can publish the account. So the first additional information is on closing inventory. And I have told you that it's good to do your workings where necessary before you begin the actual work, except for a fact that the workings are not so significant and you can do them as part of the work. Okay, closing inventory does not need any working. These are director's recommendations. So we are going to use the recommendations of the director for the income surplus account. Now, let us also be mindful of the fact that we are required to prepare income surplus account, meaning that we are not going to prepare the statement of changes in equity, I told you. But it is also possible to prepare the statement of changes in equity with this same question. When I get there and I finish preparing the income surplus account, I'm going to explain to you how we can use the same information to prepare the changes in equity. Okay, so that is it. Then there is depreciation, and then there is the corporate tax. So let us work our depreciation out and then continue with the rest of the work. Okay. Let us work out our depreciation first. Then the other workings we can do them as part of the solution. So workings. Working one will be on depreciation of non-current assets. And then we are supposed to calculate depreciation for two different assets, furniture and fittings, and then delivery van. Furniture and fittings is supposed to be 10% on the cost of $5,000, which is going to give us $500. And then also the delivery van is also supposed to be calculated on cost. That is 20% on cost, and the cost was $12,000. So that's going to give us an answer of $2,400. So we have $500 and $2,400 for depreciation for both assets. Okay. So let us now pay attention and solve the question together. Some of the other workings we'll do as we move on. Income statement for the year ended 31st March 2019. So I'll show my three currency signs, and then we are going to go according to the normal format. Now, when I say we are going to go according to the normal format, what I mean is that in the IFRS requirements, we are not going to go according to the normal format. What I mean is that over here, we are going to find our net sales in here, then less cost of sales. The cost of sales, we are going to do our own working, opening inventory, opening stock, add your net purchases, take out your closing stock and all that. Now, in the IFRS requirement, we are not going to calculate the cost of sales here. Neither are we going to calculate the net sales. We are going to do all that as workings. So when we come here, it's going to be our sales, less cost of sales. Then you get your gross profit. So within just 3 lines, you arrive at the gross profit. But it's the same thing, okay? It's the same concept. But for now, let us go according to the normal way of calculating everything for the sake of our newcomers and those who are learning. I want to make the learning process very gradual. So let us solve it according to the normal way. Then our next video on company accounts, we'll look at the published accounts where we will prepare final accounts for publication. And then we'll look at more advanced adjustments to do. Alright, so we'll begin with our sales or our turnover. So in this question, the sales figure that we were given from the question was $81,400. $81,400. Now, there were no sales returns. So this is also our net sales. And then we take out cost of sales. So we less cost of your sales. So we are going to do our calculation for cost of sales, just like we've been doing in the case of a sole trader. So in estimating cost of sales, we look at our opening stock. From the question, the opening stock figure is 9,250. So opening stock, $9,250. Then we add our purchases. Now we all know that over here we need net purchases to add. But in this question, there were no adjustments on purchases. There was no carriage inwards, there was no returns outwards or purchase returns. There was no goods drumming or freight charges, nothing. So all we can agree on is that the purchase figure that we were given, 26,808, will be the same purchase figure that will be called our net purchase. So we can bring the purchases direct as 26,880. And then when we add the purchases to the opening stock, we have our cost of goods available for sale. Which is equal to 36,130. Now we can take out our closing stock or closing inventory. The closing stock was given in the additional information. The value of our closing inventory was $5,000. And so we take out 5,000. I put that in brackets to show that I'm taking it out. Now after taking out closing stock, we have our cost of goods sold or cost of sales. In this person, there were no direct wages. And if there are no direct wages, then you can just take it straight as your cost of sales. So when we take that out, we have 31,130 as our cost of sales. So we subtract the cost of sales from the net sales, and then we have our gross profit. So the gross profit per our calculation is going to be $50,270. So ladies and gentlemen, we've arrived at our gross profit for the year as $50,270. I was explaining to you that in the IFRS requirement, the new standard for publication, what you are going to do is that right after your sales, all these workings for cost of sales would have been done outside as notes to the account. And then only this figure of 31,130 would have been brought directly as cost of sales, so that you arrive at the same 50,270. And so the only difference is that for publication, we don't show workings of the cost of sales inside the trading or account or the income statement. That is the difference. And then one other important thing that you should know is that when we get to the expenses over here, I'm going to list them. But in the IFRS, we don't list the expenses as they are. We classify them, we group them into administrative and then general expenses as one category, and then we look at the selling and distribution as another category of expenses. And then we are going to arrange each expense under any of them, and then we'll bring the final figures. So I'm not going to talk too much on that to confuse you. Let us focus on what we are doing, but I know some of you would understand what I'm trying to explain, and then we move on. So from the gross profit, we look through to see if there were any other income. If there is any other income, we just add other income before we take out our expenses to arrive at the net profit. So in this question, there was only one other income, which is the discount received of 800. I told you the discount is on the credit side, so it's discount received. So you add your discount received to the gross profit, $800. And when you add your discount received of $800 to the gross profit, it's going to give you $51,070 as your total income. So ladies and gentlemen, our total income is $51,070. And then we can now take out our expenses. Remembering that the debenture interest is also an expense, which we have to bring. But then, I'm just going to treat it as interest. So watch how I'm going to do it. So we'll less expenses. That is your operating expenses. So we are going to take out our expenses, operating expenses, as is listed for us in the question. So we begin with our wages and salaries of 6,600. Then after wages and salaries, we have administration and general expenses of 5,600. And then there was selling and distribution expenses of 2,700. So selling and distribution expenses, 2,700. And then remember there were some directors' remuneration. Directors' remuneration. And then the auditors' fees. Directors' remuneration was 8,750. And then the auditors' fees were 2,520. That is for the auditor's fees. Now, the only expenses we are left with now is the depreciation on the non-current asset and then the debenture interest. Okay, so let me bring the depreciation first. So the depreciation on the furniture and fittings, F&F, was $500, and then the delivery van. Depreciation on delivery van is $2,400. Now, normally interest is an expense, and so we are expected to bring interest on debenture. We add them all up to get a net profit. But I want to build a new culture. I want to build a new culture that the company account system is different. We try to get a profit before interest and tax. Before we charge any interest available, then we get our profit before taxes, and then we charge our tax. And so I'm going to treat the debenture interest as a finance cost over here. And so what I'm going to do is that let me first add my ordinary operating activities. Ordinary operating expenses up, and then I'm going to get a total expenses to get a net profit before interest and tax. Okay, so the total expenses is going to be 29,070. So when I take that one out, it's going to give me the net profit before interest and tax. Very, very important. That is the culture of company accounts. Net profit before interest and tax. So it means that the net profit we are going to have here is a net profit that we are yet to deduct the financing cost of interest, and also we are yet to deduct our corporate tax. So it means that it's not going to be the final profit for the company. And so when we take this out of the total income, it's going to give us the net profit before interest and tax of 22,000. So we are going to have exactly 22,000 here as our net profit before interest and tax. Then we can now take out our interest, which is the debenture interest, and then we have net profit before tax. So after net profit before interest and tax, we can take out interest on debenture, which is the only interest. If there were more than one interest, let's say you have interest on loan, interest on the debenture, interest on other financing arrangements, you would have added all of them and then you take them out as interest expense. Over here, it's just one interest. So the interest on the debenture is 15% of the debenture's value, which is 8,000. And that's going to give us 1,200. So in brackets, I put that in brackets. So I have a figure of 20,800 as a new profit, and I'm going to call it net profit before tax. So you see the difference. Over here we have net profit before interest and tax to be 22,000. Now we have net profit before tax because interest has already been subtracted. And then we now take out our taxation expense or our tax expense to get the net profit after tax. Okay, so over here I'm going to say corporate tax. This corporate tax was given to us in the question. Now, it depends on the country in which you are. Most of the time, the corporate tax will be given to you for exam purposes, or you may need to estimate that yourself by you being given a percentage or something. But at higher levels of accounting, where you are being tested on published accounts and all that, you may need to know the rate that is applicable in your country's tax regulations or tax laws for the company in particular. So we have in Ghana, for example, the corporate tax rate is 25% flat. So that is what we charge for company profits. But there are some companies that have exceptional rates, like hotels have 22%, and some other industries may have rebates and all that. So the expectation is that you, the student, you know all these tax rates and that you'll be able to apply them even when the person has not stated. But on a flat, it's 25% in my country. I don't know about your country, but some companies may have different tax rates in different countries. But for the sake of eliminating those confusions, we try to give you an absolute figure as corporate tax. just as it was done in this person. We're given $3,000 as a corporate tax. So we take out $3,000. And then when we take out $3,000, we are going to have a final profit of $17,800, which we are going to call net profit after tax. And this $17,800 is going to be our final profit for Anokoko Limited. Okay. Having been able to prepare the income statement, we look at the next requirement, which says that we should prepare the income surplus account for the year ended 31st March 2019. And I'm going to prepare the income surplus account with you, as I have already given you the format. So income surplus account for the year ended 31st March 2019. Remember that I have told you that the income surplus account is just an extract from the statement of changes in equity, as we did in the part 1 of this video. So what we are going to do over here is that we are not going to prepare the changes in equity, we are just preparing the income surplus out of that. But where there are transfers to stated capital surplus and all that, all those transfers should be necessitated when you are doing the statement of financial position. Even though if you were preparing the changes in equity, we would have done that together. So we will, for now, let's prepare the income surplus. After that, we'll look at how to explain that as well. So we are going to begin with the opening balance, which is the balance brought forward from the previous year for the retained profit. And we have that in the trial balance as $9,500. So $9,500. And then we add our net profit for the year. And I told you that we have 3 different net profits. Net profit before interest and tax, which we also call the operating profit. We have net profit before tax and a net profit after tax. When it comes to the income surplus, we are bringing the final profit, which is the net profit after tax. And the value is $17,800. That is what we are adding to the already retained profit that we have from the beginning of the year, before we can make payments for dividends and make any other transfers out of this same income surplus. And so that is going to give us $27,300. And then we can now do our appropriations out of the income surplus. So we know that the income surplus account is what is used to pay our dividends and then make other appropriations from the profit before we know the final profit that will be retained at the end of the year. Because in a company account, they don't spend all the profits, they keep and maintain some for expansion, which we call the surplus of income or the retained profits. Now this is where we need to pay attention to the recommendation of the directors in the additional information. We are told that the directors have recommended the following. First one is to write goodwill off at $1,900. Now, goodwill was given to us at a value in the trial balance. So we are writing it off. And the account that is used to write off goodwill is the income surplus account. Don't make a mistake and bring that as an expense, I beg you. So we'll take out the goodwill written off. So we started with appropriations. Goodwill written off 1,900. I can put that in brackets anyway. So we are subtracting that. Goodwill written off. And then also we have the directors also recommended that 1,000 of preliminary expenses should be written off. So just as we are writing off goodwill, we'll say preliminary expenses. That will also be written off just as goodwill. It is not coming into the expenses, I beg you. It's supposed to be done in the income surplus. So written off 1,000, also in brackets. And then the next item to appropriate. We are told that the transfer of 2,500 is to be made to capital surplus. And so transfer to capital surplus. That is 2,500, also in bracket. You can decide to list all of them, add them before you bring the bracket. That is also acceptable. And then we are also supposed to make dividend payments. We are supposed to make a dividend payment of 10 cents per share on ordinary share. Now, this is where we have to look for the total number of ordinary shares. So we say ordinary share dividend. It's also a subtracting item. That is 10 cents per share. Now, how do we calculate this 10 cents per share? We have to look for the total number of ordinary shares that are in issue. And this is where I want to draw attention to something. From the beginning of the question, we were told that the company has an authorized share capital of 60,000 ordinary shares. 80,000 ordinary shares and 60,000 preference shares. Now take note, 80,000 ordinary shares does not mean that the authorized shares of 80,000 is what we are going to calculate with. Authorized share capital have been explained in the issue of shares of company account, which I've already uploaded on YouTube. You can look at that to understand the types of shares and how they work under the introduction to company account. Now, we have in the trial balance a stated capital of 60,000 ordinary shares. So it means a fully paid. It means that even though we are authorized with 80,000 ordinary shares, we have only issued and paid for only 60,000. So we are actually working with 60,000 shares. And that is why the dividend should be paid only on the 60,000 shares, not on the authorized. As for the authorized share capital, it's just for information purpose. It's not going to be used in anything we are doing. So don't let that one confuse you. We need what is in the trial balance, what we are actually using. So we are going to pay a dividend of 10 cents per share. So $0.1 times 60,000 ordinary shares, which is actually the shares we are using to work. And 10 cents times 60,000 is going to give us 6,000. So the dividend that is to be paid for ordinary shares is going to be $6,000. And then also we are supposed to pay our preference dividend also out of the income surplus. Now, the preference dividend is supposed to be calculated as a percentage, 10% preference share. The value of the preference share is $20,000. Now take note that with the ordinary share, the directors recommended that we pay 10 cents per share, meaning that it's supposed to be calculated on the ordinary shares, the number of ordinary shares, not necessarily on the value of the ordinary shares. But over here, with a preference share, so preference dividend, in that case, we are going to look at a percentage on the value of the preference share. So the value is $20,000. So 10% of 20,000 is going to give us $2,000, which will also be in brackets because it's an outward appropriation from the income surplus. So please take note of this very well, that when it comes to the ordinary share, we multiply by the number of shares. Or the preference share, we multiply by the value because of it's a percentage on the value, not on the shares. So this is our preference dividend. So these are the things that are going to be paid out of the profits that we have gotten. So when we subtract all that, the final value we have is our closing value for income surplus, which we need. Okay. So when we add all these appropriations, there were no additions. There could have been additions. That one I wouldn't have brought the bracket. But over here, everything was a subtraction. And the total is 13,400 negative. So when we take that out from the total profits, we are going to have a final balance of 13,900. That is if I'm right. And that is going to be the balance carried down on our income surplus account, the closing balance, 13,900. This is our final balance of the income surplus account. If you don't understand this, look at it again and then repeat, and then try and then look at the question and see how best you can help yourself. Okay. So, having completed the income surplus account, the final thing to do is the statement of financial position. Remember that we did not prepare changes in equity. If we had done, probably income surplus is always the most changed or the most changed item of equity, with the exception of the fact that there is a transfer to capital surplus. So if we had prepared statement of changes in equity, the capital surplus balance would have increased by this same, because once we are taking it out of the income surplus, we will add it to the capital surplus. But we will still have to add it in the statement of financial position. So let us take note. So I'm going to clean this, and I'm going to use the space to prepare the statement of financial position. Alright. Statement of financial position. As at 31st March 2019. Okay, so you begin with your non-current assets. Remember that I told you that the preliminary expenses will be capitalized, and then there is goodwill. So let us bring them first as intangibles. And so we have costs, accumulated depreciation, and then we have the net book value of the carrying amount for the non-current assets. So we had goodwill, which is an intangible non-current asset, and then the value of goodwill was 9,000 from the question, and then we wrote off 1,009, so that is amortization of goodwill. So we have a final balance of 7,100 for goodwill, and then there was preliminary expense, which I explained to you. The value was 10,000. We wrote off 1,000 also as amortization. So, yeah, and then we have 9,000 as a final value. Then let's bring in our tangible non-current assets. We have land and building in the question. The value for land and building in the question was 25,000, but it did not depreciate. There was also freehold property of 12,500. So 25,000 for land and building, and then freehold property 12,500. There was no depreciation charge for any of them, so the net book value remains the same. Alright, let us look at other non-current assets that we have. We had furniture and fittings and delivery van, which were both depreciated. So furniture and fittings had a value of 5,000 at cost, and then there was a delivery van which also had a value of 12,000 at cost. Now remember that the furniture and fittings had an accumulated depreciation of 2,000 Ghana cedis in the question already, and then this year we calculated depreciation and we had 500. So when we add $500 to the $2,000, we have $2,500 as accumulated depreciation on furniture and fittings. And then with the delivery van, there was already an accumulated depreciation of 3,200. And then this year we calculated we had depreciation of 2,004. When we combine, we have accumulated depreciation of 5,600, and that is going to give us our new net book values for those two assets. So we have 2,500 for furniture and fittings, and then we have 6,400 for the delivery van. So that is how we arrive at each of them. Then we can do the underline and then leave the net book value for the other workings to be done with it. I'm sure you are familiar with this format from the sole trader. Nothing really has changed. So we have a total of 73,500 for the cost, and then we have a total of 11,000 for the accumulated depreciation. And so we are going to get a net book value total of 62,500. So that is how to go about the non-current assets. And then we can move on to our current assets list. Under the current assets, we arrange them according to liquidity. So we start with our inventory or stock. The closing stock value was 5,000. And then we had trade receivables. Fortunately, there were no provisions for doubtful debt or anything like that. So our trade receivables in the question was 16,000. And then we have cash at bank. The value for cash at bank was 22,500, and there was a cash in hand balance. And then the value for cash in hand 6,600. So when we add these four up, we have our total current assets, which is 50,100 Ghana cedis. And then we have current liabilities. I know my teaching has been a little dull today. I'm not feeling too well, but I shall be well. So please pardon me for that. I'll fire up in the next video. I'm looking a little dull. Okay. So let's move on. Now when we get to current liabilities, this is why I want you to pay attention, because it's not only going to be trade payables. Now remember that I told you that debenture interest owing, when we have not paid, in this question there was no debenture interest paid. So the whole amount of debenture interest will come as a liability. And then the tax, the corporate tax which we sent into the income statement to subtract from the profit, the tax also is a liability because it's in additional information, it has not been paid. So the tax will come as a liability. And then also let us take note that all the dividend proposed will also come as liabilities, because there was nowhere in a trial balance we could find them, meaning they were not paid. And once dividends are not paid, they are liabilities. Tax are not paid, they are liabilities. Interest not paid, they are all liabilities. So the company accounts may have much liabilities compared to the sole trader's case. And I remember mentioning some of these things in the format I gave you. And so let us begin with our trade payables. And in this question, the trade payables figure was 14,000. And then we have interest on debenture payable, which is 1,200. And then also we have the corporate tax. That is also an owing. The corporate tax was $3,000. Sorry, I said Ghana cedis earlier. $3,000. And then we have the dividends. We have the ordinary dividends. We had it to be 6,000 proposed, and then we had the preference dividend to be 2,000. So ordinary share dividend 6,000, and then we have the preference share dividend to be $2,000. So these are our liabilities. In fact, if you are not careful, you miss some of these figures. So be very careful. Your payables, I know that one you are very much okay with that. But any taxation on pay, any interest on pay, any dividend on pay will all end up as liabilities in the company account center. So we add up all our current liabilities. And that is going to give us 26,200. So we have 26,200 as our total current liabilities. When we subtract that from our total current assets, we are going to have our working capital. And the working capital is going to be $23,900, which we are going to subtract, we are going to add to the total non-current assets to get our capital employed. And that is going to give us 86,400, and that is our capital employed. 86,400. That is the capital employed. So this is how to go by the first half of the accounting equation as far as the statement of financial position is concerned. And then we look at financed by the second part of the equation. Financed by, how were these assets financed? So we begin with the equity component. And under the equity, there is a stated capital, which is the ordinary share capital. The ordinary share capital in this question is 36,000. Okay, and then we add our income surplus balance. Remember that I told you that let us not mix the items of debt with equity. Preference shares is to be treated as long-term liabilities. So income surplus, we are going to bring the closing balance from the income surplus account that we prepared. And that was 13,900. We have 13,900 as our income surplus balance. And then there was also capital surplus in the question. Now in the question, the capital surplus figure was 6,000 from the beginning. And then we transferred 2,500 from income surplus to capital surplus. So that's going to give us a total of 8,500 for the capital surplus. And that will give us our total equity figure before we move on to the long-term liability aspects. So we know that over here is two things. It's your equity and then your long-term liability. Once your current liability has already been adjusted, then the equation is left with the equity component and the long-term liability component. So we are going to have a total equity of $58,400. And then we come to the long-term liabilities. Under long-term liability, we have 10% preference share, which is 20,000. And then also we have 15% debenture, which is 8,000. So we can just add that up to see our final figure. So 28,000 plus 58,400 is going to give us 86,400, which is exactly as what we had here. So that is our capital employed that we are quoting again. You can still call it your capital employed. This is how to go by a typical final account of company, and I'm sure your understanding has been enhanced. Now what I want you to do is to look at it again, find a question and try solving on your own to see how best you can understand. In our next video on company final accounts, we are going to go into published accounts, final account for publication, and then we are going to apply the IFRS rules very strictly, where I'm going to teach you how to prepare the PPE schedule, and then we can zoom into higher levels of financial reporting. Yes, remember to recommend this channel to someone else. Subscribe to this channel, share this video, comment and let us know your views. Like it if you have been helped, and then let us all grow together and then be happy. So until we meet again another time for another lesson, it is bye for now.